Welcome to another explainer. Today, we're diving straight into Unit 3, Finance and Accounts. Now, you might be thinking this is just dry math and boring spreadsheets, but actually, scratch that. It is so much more. Finance is really the dynamic, high-stakes storytelling language of business health and survival. Think about it. If you want to know if a company is truly thriving or dying, you don't look at their marketing, you look at their accounts. So here is a massive, high-stakes question to kick things off. Why do profitable businesses still go bankrupt? It sounds like a total paradox, right? If you're making millions in profit, how could you possibly fail? Well, stick around, because in today's explainer, we are going to reveal the ultimate financial trap that literally destroys growing businesses. It's a trap so subtle that even massive global operations fall right into it. Okay, let's dive into this. Here's our roadmap for today. 1. Fueling the business engine. 2. Tracking costs and revenues. 3. Reading the financial scoreboard. 4. Why cash is king. And 5. Making smart financial decisions. All right, part 1. Fueling the business engine. Every single business needs money to survive. So let's think of your business like a car. You have capital expenditure, which is the money you spend buying the car itself. That's the engine, the machinery, the premises, the vehicles. These are your non-current assets that you're going to use for more than a year. On the flip side, you have revenue expenditure. This is the money you spend on the gas to actually run the car. The day-to-day items that get used up super quickly, like fuel, raw materials, and wages. And the thing is, you have to secure funding for both. So where does this financial fuel actually come from? Well, managers have to balance two main pumps. Internal finance is money found from within the business. Things like the owner's personal funds, selling off unused assets, or reinvesting retained profits from previous years. It's incredibly safe because you aren't taking on any debt, but sometimes, you just need a bigger injection of cash. And that's where external finance comes in. This is taking out loan capital from a bank or issuing share capital to investors. It gives you immense power to grow, but it brings massive risk. And that risk is very, very real. Our source highlights this absolutely fascinating case study from Pakistan's cement industry. A few years ago, companies in this sector were facing crippling interest rates of around 13% on their long-term borrowing. I mean, just imagine paying 13% just to hold on to the external finance you used to build your factories. It became a massive, heavy cost that completely dragged down their financial performance. This shows exactly why the source of your finance matters just as much as the amount. Let's move to part 2 and see how this builds, tracking costs and revenues. Once that engine is fueled, the business starts burning through it. Every business deals with expenses, but we have to divide them into two very distinct categories. Fixed costs are your heavy burdens. These are expenses like factory rent, management salaries, and those interest payments we literally just talked about. They do not change with your output. Whether you produce 0 items or 1,000,000 items this month, the landlord still wants the exact same rent check. Variable costs, however, like raw materials and production line fuel, change directly with your output level. You make more products, you pay more variable costs. So, the crucial point here is understanding a concept called contribution. This is the difference between your sales revenue and your variable costs of production. Let's say you sell a product for $10 and the variable materials to make it cost $4. That leaves you with a contribution of $6. But wait, that is not profit. That $6 simply contributes towards paying off your massive pile of fixed costs. Only after all the fixed costs are completely paid off does that contribution finally turn into actual profit. And honestly, managing these operational costs is incredibly difficult, even for the pros. Take the Ford Motor Company, for example. In 2019, their profits dropped incredibly sharply to just $47 million. Why? The company pointed directly to unexpected operational costs associated with launching a new model of their Explorer car. When costs slip out of control, boom, the profit margin vanishes instantly. Moving right along to part 3, reading the financial scoreboard. To check the health of our engine, we look at two main dials on the dashboard. First up, you have the statement of profit or loss. Think of this like a video recording. It tracks your revenues and costs over a whole trading period, usually a year, to show if you actually made a profit. The second dial is the statement of financial position, which was historically known as the balance sheet. Now, this is not a video. It's a photograph. It takes a snapshot of exactly what the business owns, its assets, and what it owes, its liabilities, on one specific day. And this brilliantly illustrates how we measure financial health from two different angles. But here is a tricky part about measuring what a business owns. Things wear out.
Our source uses this great example of a farmer who buys a brand new tractor for $250,000. Over the next few years of heavy use, that tractor is for sure no longer worth $250,000. If the farmer's balance sheet says it is, the business is completely overvalued. That's why accountants use depreciation. It's a mechanism to steadily reduce the recorded value of a non-current asset over time. It ensures the financial scoreboard is telling the cold, hard truth.
Which brings us to part 4, why cash is king. We are now at the absolute most vital part of our journey today. Why do seemingly healthy, highly profitable businesses suddenly collapse and go bankrupt? To understand this trap, you have to answer this question. What is the exact difference between cash and profit? Because confusing these two things is the #1 reason growing businesses fail.
Here is the brutal reality. Profit is really just a concept on paper. It's the surplus of revenues over total costs over a trading period. Cash, however, is a physical, liquid asset. It's the actual money sitting in your bank account right this second. You could sell $1 million worth of products today and record a massive profit. But if your customers bought on credit and haven't paid you yet, your cash flow is zero. You're highly profitable, but you have literally no cash to pay your own suppliers tomorrow morning.
And if you cannot pay your bills when they fall due, you face insolvency. You go bankrupt. And it turns out this happens to the best of them. I found this case study absolutely shocking. A major US banknote printer, a company that literally prints money, ran out of cash to pay its bills, despite having recorded £31.5 million in profits. No way, right? But they were wildly profitable on paper, while their actual cash inflows were completely out of sync with their cash outflows.
So, how do managers pull a business back from the brink of insolvency? They have to deploy aggressive cash flow strategies. They might delay payments to their own suppliers just to keep cash in the bank a little longer. They might stop offering credit and insist customers pay cash up front. They might use debt factoring, which basically means selling the money they are owed to a bank for an instant, slightly reduced cash payout. Or they might reduce their stock levels so cash isn't sitting frozen in a warehouse. It's all about keeping the oxygen flowing.
Finally, part 5, making smart financial decisions. If a business survives the cash flow trap, it eventually has to look to the future. How does a business decide where to invest its hard-earned money to guarantee future growth? Take Cargill, for example, the massive agriculture company, and their decision to launch a $113 million expansion plan for cocoa processing in the Ivory Coast in Ghana. You don't just guess with $113 million. Managers have to rigorously appraise whether such huge investments are actually going to generate enough return to be worth the risk. Now, what's really interesting here is how managers actually do this math using a few different tools. First is payback, which is simply calculating how many years it takes to earn the initial money back. It's easy, sure, but it totally ignores any profits made after that date. Then there's the average rate of return, or ARR. This measures the overall percentage profitability, making it super easy to compare against bank interest rates, but it ignores the timing of the money. Finally, there's net present value, or NPV. Because money today is worth more than money in 5 years due to inflation and interest, NPV systematically discounts future cash flows to their present value. It's highly complex, but it's absolutely the most accurate way to judge a massive multi-year project. We've covered a lot of ground today, tracking the lifeblood of an organization. But if you take away just one single concept from this explainer, let it be this: adaptation of a core business truth. Profits are the applause, but cash flow is the oxygen that ensures business survival. You can have all the sales, all the applause, and all the on-paper profits in the world, but if the cash stops flowing, the business suffocates. Finance isn't just about balancing the books. It's about seeing the true story of an organization. So I'm going to leave you with this. If you could hack into the financial dashboard of your absolute favorite brand today, what would you see? Would you see a well-oiled engine with strong cash reserves and smart capital expenditure? Or would you see warning lights flashing red from hidden debt and a desperate lack of liquidity? Next time you read the business news, look past the profit headlines and look for the cash. Thanks for joining me on this explainer, and keep questioning the numbers.